We're going to start out with the super fun and interesting calculating the total amount deferred on a non-qualified plan. We have two different methods. We have the present value method or the discounting present value method because, it's the IRS and they're not going to make anything super clear. It's all going to be clear as mud. So the present value method is proposed regulations provide that the total amount deferred under a plan for a taxable year is the present value of the plan on the last day of an employee's taxable year of all amounts payable to the employee under that plan, plus amounts paid to the employee during that taxable year. The discounting present value method, those same regulations provide that the present value cannot be discounted for the probability that payments will not be made or be reduced because of unfunded nature of the plan, risk associated with any deemed investment of amounts deferred under the plan, risk that service recipient or other party will be unwilling or unable to pay the amounts deferred under the plan when due, the possibility of future plan amendments, or the possibility of future changes in the law or similar risks or contingencies. There's always going to be that little caveat of, we're going to cover you if you follow this other method. The restrictions not taken into account in determining that present value, those same regs further provide that restrictions on payments that will or may lapse with the passage of time, such as temporary risk of forfeiture that is not a substantial risk of forfeiture, are not taken into account in determining present value. Also, any potential additional deferrals contingent on a bona fide requirement that the employee perform services after that taxable year, such as potential salary deferrals, service credits, or additions due to increase in compensation, those items would also not be taken into account in determining the total amount deferred for the taxable year. There's also special rules for determining the present value. Generally, those regulations require the use of reasonable actuarial methods and assumptions and provide specific rules. On the crediting of earnings for situations where an amount is payable pursuant to alternative times and for payment and forms of payment, for situations where amounts are payable on the occurrence of a triggering event rather than on a fixed date, for situations where the amount payable is determined in accordance with a formula rather than being set on a fixed amount, and for various types of plans listed on the slide. You can see all of those types of amounts or types of plans. You have the account balance plan, the non-account balance plan, stock rights, separation pay agreements, reimbursement arrangements, etc., etc. Determining the portion of the total amount deferred for a taxable year that is subject to a substantial risk of forfeiture, those regulations provide that the portion of the total amount deferred for a taxable year that is subject to that risk of forfeiture or not vested is determined as of the last day of the employee's taxable year. You can see your example that says if a plan fails to comply with 409A due to an operational failure on July 1 of a taxable year and the substantial risk of forfeiture applicable to an amount deferred under the plan lapses as of October 1 that same taxable year, that amount would be treated as vested amount for purposes of determining the amount includable in income for the taxable year. When you're determining the portion of the total amount deferred for a taxable year that has been previously included in income, for a deferred amount to be treated as previously included in income, the regulations would require that the service provider actually and properly have included the amount in income in accordance with the Internal Revenue Code. This would include amounts reflected on an original or amended tax returns that have been filed. The example again, if an employee includes 100,000 in income under 409A, and 10,000 of that amount consists of a payment under the plan during the taxable year, only 90 would remain to be treated as a deferred amount previously included in income. Of course, still clear as mud, right? Your first pop quiz. In 2020, an eligible employee may make a catch-up contribution up to what amount beyond the deferral limit in a 401k plan? You guessed it, $6,500. When a 401k plan allows catch-up contributions, eligible employees, which are employees age 50 or older at the end of the plan year, may make catch-up contributions up to $6,500 in 2020. Keep in mind, as you are the one with fiduciary responsibility in a plan, to look at those contribution limits every year. They change. Non-qualified plans continued. The treatment of failures continuing during more than one taxable year. So these plan failures. Each of the employees' taxable years must be analyzed independently to determine if amounts were includable in income. This means a service provider who includes an income under 409A, all amounts deferred under a plan for a taxable year would not be relieved of the requirement to include amounts in income for earlier taxable year in which the failure also occurred. This rule ensures that a service provider isn't selecting among several previous taxable years to use that most favorable year to include in income. Premium interest tax. If compensation is required to be included in gross income, the income tax imposed is increased by an amount equal to the amount of interest determined under 401A. This additional tax is a premium interest tax. In the example, assume an employee who participates in a plan has a total amount deferred in 2020 of $100,000 and a total amount deferred in 2021 of $80,000 due to deemed investment losses in 2021. If the plan fails to meet the requirements of 409A in 2021 and not 2020, the employee is required to include $80,000 in income under 409A. In calculating the premium interest tax, the employee must allocate only $80,000 required to be included in income under 409A to the year or years the amount was first deferred or vested, even though additional amounts were deferred under the plan in previous taxable years. Additionally, the amount to which the premium interest tax applies to is the amount that is required to be included in income under 409A for the taxable year is only deferred under the amount that is required to be allocated to previous taxable years. Identifying those amounts deferred in a particular taxable year. To calculate that premium interest tax, your first step is determining the taxable years during which the amount required to be included in income was first deferred or vested. If your service provider first participated in a plan in the taxable year 2020 and has a vested total amount deferred under the plan for 2020 of $10,000, a vested total amount deferred for 2021 of $15,000, and a vested total amount deferred for 2022 of $25,000. The service provider would be treated as having first deferred $10,000 during 2020, $5,000 during 2021, and $10,000 during 2022. Identifying the amounts deferred in a particular taxable year. The amount deferred during a particular taxable year generally is the excess, if any, of the vested total amount deferred for that taxable year over the vested total amount deferred for the immediate preceding taxable year. Little hint, this rule generally should result in the lowest amount possible of premium interest tax, because deferred amounts includable in income under 409A would be treated as first deferred and vested in the latest possible years. When you're calculating a hypothetical underpayment, this kind of hypothetical underpayment would be calculated as if the amount were paid to the employee as a cash payment of compensation during the taxable year. So your example, the impact such additional compensation would have had on contributions to a qualified plan, even if the additional compensation would have affected the amount the service provider would have been permitted or required to contribute, would be disregarded. Let's get into some tax treatments. Yay! Our treatment of payments or losses of deferred amounts in taxable years after they are included in income. For payments, if an employee includes an amount in income under 409A, regulations provide that the amount would not be required to be included in income again, like when the amount was actually paid. So at least you don't have to pay tax on things twice. Forfeitures or losses. If an employee is required to include an amount in income under 409A, they're entitled to a deduction at the time the employee's rights to that deferred comp in the plan is permanently forfeited or compensation is lost. Payments not subject to reporting. There are several types of payments that are not subject to reporting on W-2 due to a 409 failure in non-qualified deferred compensation plans, such as your separation or severance pay agreements, 457 plans, reimbursement arrangements, stock options, and your stock options would be considered those non-discounted stock options that have no other feature for the deferral of compensation under that 409A. Additional taxes. Sometimes additional taxes must be paid. If the typical requirements of a 409A are not satisfied, then in addition to the value of the employee's account being included in income, Interest will also be imposed on that compensation as if it had been income when it was first deferred, or when not subject to substantial risk of forfeiture, and the amount required to be included in income is also subject to an additional tax of 20% that the employee pays when filling out their personal income tax. Your reporting and withholding requirements. All amounts deferred under a non-qualified plan in a calendar year must be reported on Form W-2, Box 12, Code Y, whether or not included in income or reported wages for that year. When a plan fails to meet the 409A requirements, the income is included in Form W-2, Box 1 and 12 with the code Z. In addition, the income is also subject to that additional tax of 20% not withheld by the employee. It's that penalty that comes into play. Non-qualified deferred compensation plan, Social Security and Medicare taxation. So your Social Security, Medicare, FUTA tax treatment of employer contributions on a non-qualified deferred compensation plan is somewhat different from the income tax treatment. It doesn't matter whether the plan is funded or unfunded if it meets or does not meet the requirements of IRC, Internal Revenue Code 409. Employer contributions and earnings are subject to Social Security, Medicare, and FUTA tax on the latter of the date the services are performed or when there is no substantial risk of forfeiture or vesting of the employee's interest in the funds. Keep in mind that typically these contributions will likely never be subject to Social Security or FUTA tax under this special timing rule, because your typical C-suite or executives earnings on a non-qualified deferred compensation plan are almost always higher than that wage base for each plan. But they will be subject to Medicare tax, including the additional Medicare tax assessed on wages over $200,000. So there's always those little if this then that type treatment when it comes to calculating these. While they're saying you're supposed to pay your Social Security and Medicare tax, you just have to keep in mind that quite often those executives, their pay is already above the threshold for having to pay the additional tax on those. When you're determining the amount deferred must be the amount taken into account as wages for that period under the special timing rule. The manner in which the amount deferred for a period is determined totally depends on whether the non-qualified plan is an account balance plan or a non-account balance plan. A non-qualified deferred compensation plan is an account balance plan if, number one, the principal amounts are credited to an individual account for the employee. Two, the income attributable to the principal amounts is credited or debited to the individual. And three, the benefits payable to the employee are based solely on the balance credited to that individual account. Individual meaning individual employee, not a pool of employees that are sharing a bucket. Simply stated, a non-account balance plan is any plan that is not an account balance plan. the amount deferred for a period under a non-account balance plan equals the present value of the additional future payments to which the employee has obtained a legally binding right to that period. When are those deferred amounts taken into account? When it is included in computing the amount of wages subject to Social Security, Medicare, and FUTA. However, this is true only to the extent that any additional taxes, penalties, interest resulting from the inclusion are actually paid before the expiration of the applicable period of limitation for that year. Your withholding rules. For purposes of withholding and depositing Social Security, Medicare, and FUTA, an amount deferred is treated as wages paid by the employer and received by the employee at the time it is taken into account. If the employer is unable to calculate the amount deferred for a year by 12/31, you have two alternative methods you can use: the estimated method and the lag method. The estimated method is where the employer may treat a reasonably estimated amount as wages paid on the date in which the amount is taken into account. Of course, special treatment must be taken if that amount ends up being underestimated. And the lag method allows an employer to calculate the amount deferred on any date up to 3 months after the date the amount was required to be taken into account. That amount deferred will be treated as wages on the latter date and the amount deferred must be increased by income earned through that date on which the amount was taken into account. So of course, when thinking about that lagged method or estimated method, if you're taking that lag method and those wages change, those need to be taken into account that were once it's actually applied to their individual accounts. Your reporting requirements. Employer contributions or amounts deferred to an unfunded, non-qualified deferred comp plan that meets requirements of a 409A are not included in income and are not reported in box 1 of the employee's Form W-2 as taxable wages. Amounts deferred to a funded secured plan or a plan that does not meet the requirements of a 409A are income if the employee has no risk of losing the benefits, like no future service needed to be performed or required of payment. Therefore, they must be reported in box 1 as taxable compensation, and most generally in boxes 11 and 12 with the code Z as taxable income from a qualified plan. Your amounts deferred must also be reported in box 3 as Social Security wages, box 5 as Medicare wages once there is no risk of forfeiture. Amounts withheld as Social Security and Medicare taxes must be reported in box 4 and 6. Amounts distributed from a non-qualified deferred compensation plan were not considered income when originally deferred must be reported in box 1 and 11 only. Amounts deferred that must be included in box 1 of Form W-2 would also be included on line 2 of your 941. Amounts withheld for federal income tax from taxable deferrals or distributions must be reported in box 3. Amounts that are currently subject to Social Security and Medicare taxes must be reported in lines 5A, column 1, and 5C, column 1. These amounts must also be included on Part 2, line 3 of the employer's 940. Then we have our last pop quiz. And I'm going to give you a few minutes to complete this calculation because it's a little tricky. So here is the information needed for your calculation. Does anyone have any questions while you're working through that worksheet or the, your tax calculation? Okay, so here's our worksheet. We know that this is a non-exempt employee who makes an hourly rate of $18 an hour. We know that weeks 1 and 2 both had overtime, so you're going to calculate that overtime rate for a non-exempt employee. You can see that line 1A, you're going to put their total gross wages less that 1% that they requested to have as their 401k contribution. You're also going to list the number of pay periods because they are a bi-weekly pay period. It's 26. We do not have step 4 from the W4, so that's going to be 0. And of course, 0 from 0, still 0. We come up with lines 1A and 1D are still the 182655. And all the way down, our adjusted gross wage amount is 182655. Then if we take a look at our tax information, we know that this, from what this person claimed, we need to go to, for 1,260, their gross wages of 1826.55 would fall between 1260 and 2783. So line 2A is going to be 1260. 2B, they're asking for column C of that row of $54.30. And then they're asking for that next column of 12%. Subtract line 2A from 1H. 2A is that 1260 minus 182655 gives us $566.55. You're going to multiply the amount on line 2D of 566.55 times 12%, and it gives you that number. Add lines 2B of the $54.30 in our chart plus 67.98, we get 122.28. Then step 3 of that employee's W-4, they claim $2,000 for dependent. Divide that by 26 pay periods. You get 76.92. Subtract line 3B minus 2F, so 122.28 minus 76.92, we get that 45.36. So over here in the boxes on the left-hand side, you can see we have a breakdown for that gross wage originally was $1,845. We're going to take away $18.45 or the 1% 401k contribution. Your federal income tax that we just calculated of $45.36. And then our Medicare 1.45 times the full amount, because again, even though they have a 401k contribution, you're still paying Social Security and Medicare. So they're paying that full 1826, they're paying the full 1.45% and 6.2% respectively for Social Security. That gives us a breakdown of 164005 for a net pay. And I'm going to go back to this. So while this quiz came up with 164007, it is due to rounding. So I saw a couple of people in chat had that same thing, that they were getting that rounding by a penny or 2 pennies. Keep that in mind when you're going through the CPP exam. You will come up with items where it's a penny or 2 pennies off. So obviously you're going to have to accept that rounding does happen. Especially with this particular, I think this new W-4 has a little bit more rounding issues than what the previous federal income tax tables had. So I did make a few notations of things that I saw on the CPP exam for myself. And I'm telling you, this particular breakdown is going to be key. You're going to need to know how to calculate that net pay with your 401k pre-tax and a Roth. Those are so important to be able to know and make sure that you're reading through those questions, because if you're assuming that it's a Roth and it's 401k or vice versa, they likely will have the opposite one as one of your multiple choice options for an answer. So if you're not reading that, you could still find a right answer that you think is right, but you're not following exactly what that question is asking for. You'll want to know not only the definition of an ADP test and what it does, but also what do you do when your plan fails? How do you get it back in compliance? I mean, certainly it's not going to be, well, we just scrap it and we move on and build a new plan. That's not an option. But also for real world maintenance of a 401k plan. Nowadays, the responsibility for your benefits and payroll deductions have really split into 2 different areas, where your HR department or your benefits department is taking care of those enrollments and that piece of it, where payroll and finance is handling those deductions and payments of those benefits. Keep in mind that you have that fiduciary responsibility to maintain that plan. It can't just be, well, it's on the other guy. It is still on you, and you always have to make sure that you're keeping compliance and ERISA rules in mind. So with that said, we have 3 minutes. Any questions?
Okay, I have a question about the test. I was in PayTrain and I was doing a couple of the practice exercises, I think they called. And part of the instructions was to, instead of calculating by the pay period, they had you convert everything into what the annual taxes would be, what the annual salary would be, and the annual deductions would be, and then divide that down to the pay period. Is that a more common way to do the calculation? Like, I know we talked earlier about like when you're doing just like a gross pay, that you want to do overtime. How did we say that? Like regular time plus half time to get overtime. What is the best approach to finding net pay? Do you convert it up to annual and then do all the math?
In my opinion, there's really no best practice, so to speak, when it comes to calculating that, because there are so many variables. It's going to depend on what type of plan you're calculating out, what type of contribution, how old the participant is, what they're what kind of target they're trying to reach. Are they going to be a highly compensated employee? There's so many variables that come into play. That's why they would have you do it on an annual basis, because that could trigger you those red flags of going, oh yeah, now this is going to come into play, or that's going to come into play. I honestly, for the test purposes, I didn't have anything other than calculating out a net pay for biweekly. Yes, sometimes they give you that annual salary instead of an hourly rate, but it didn't make you calculate it out on an annual method and then break it all the way down. The PayTrain is pretty much having you do that, not just for real world examples, but just to make sure you understand how all those things come together.
Okay, thank you. Because I was getting so frustrated because I was like 16 cents off.
Right. I mean, even stop and think about, when you pay someone a annual salary of, let's just say 120,000. If you break that down into 24 pay periods versus 26, you get something completely different, and the rounding hits different, and all of those good things. It's okay. Another thing for the CPP, I think I had weekly, bi-weekly, and a monthly pay that you had to break down to that net pay for all different types of calculations. Majority of the calculations I saw, I only had 1 or 2 that were real simple, where they were only wanting you to calculate that federal tax. Majority of them were full on, like what we just did, where you're calculating for hourly overtime, so time and half time, and then including those cafeteria plans, which we'll get into next week, the 401k, all of those things, how those come into that bottom line of someone's net pay.
And I know we're running over, but just one more question. So you said that on the questions on the exam, when they asked for federal income tax, they were just asking for like what you would calculate on the worksheet, rather than when they asked for federal taxes, that meant
everything. Yes.
Okay.
That means including Social Security and Medicare, but they're not going to specifically ask you what that Social Security and Medicare tax is. If they ask on the questions for federal income tax, they're wanting the withholding amount. If they're asking for federal tax, they're going to ask for all of the above.
Great, thank you. Okay, well, that's time. Thanks for teaching us this week.
Sure. I'm going to try to stop sharing. There we go. Okay.
I hope everyone has a lovely weekend. And Melissa, I hope you have a great week.
Thank you. I'll see you
Yes.
all. Talk to you all next Thursday.
Yes,
Alright.
enjoy.
Thanks.
Shut your head off for a couple days.
I'll try. Thank you.
Yep, bye.
Bye.